So the first question I got is from Greg, and he says, what do I pay taxes on? The money I use to grow my business, the money I use for materials, which are taxed themselves, the money I pay myself, the money I put away for a big purchase for my business, every penny I take in, what? So this was a great question. So essentially, Greg is asking he wants to know what his taxable income is. All right, so how do we calculate your taxable income? So your taxable income, you guys, is going to be your revenue less your expenses equals your taxable income. Okay, so let's start with the revenue. So revenue is, like Greg said, every penny you take in. Every penny you take into your business for the services or goods you provide, that is your revenue. All right, so then after we know what our revenue is, every penny brought in, then we subtract all of our expenses. All right, so this is going to include all of the money that goes out that is business related, okay, give or take. There's a few exceptions here and there, but let's just go with all money that goes out for business related purposes. So in Greg's question, this would include the money he uses to grow his business. So that might be new employees, advertising, rent for workspace, maybe software that you need to run your business. All right, and it's also going to include the money you use for materials. We usually call that cost of goods sold. All right, so the expenses used to run your business are going to include all of that. Some of the things in Greg's question that this would not include is the money Greg is saving for a big purchase is not an expense. Okay, so money that you're putting aside, whether it's into a business savings account, into a separate personal bank account, whatever it is, taking money out of your checking for savings is not going to decrease your taxable income. All right, so this money is going to sit in savings, and then when you eventually go to make that big purchase, we've got a different story. All right. It may be considered an expense if it's less than $2,500. Okay. So maybe it's a piece of machinery. Maybe it's a new laptop or computer for your business. Maybe it's new furniture. If it's less than it's called a safe harbor, or no, it's called the de minimis safe harbor. So if it's less than that $2,500 threshold, typically the IRS is going to just let you expense that in the year you spend the money, okay? But if it's more than that, it's going to be considered a capital asset, all right, which is not necessarily all expensed in the first year, okay? What happens with that is a capital asset goes on your books, on your balance sheet as an asset, and then you do what's called depreciate. Okay, you depreciate it, meaning you take a little bit of the expense every year over the life of the asset. However, there are a lot of accelerated and bonus depreciations and things called Section 179 that allow you to take more or sometimes all of the expense of the depreciation expense in the first year. So this is 100% why you need a tax advisor, okay? Whether it's me or someone else. If you are buying big, expensive equipment, expensive being $2,500 or over, you definitely want to consult with a tax advisor to figure out how that's going to affect your taxable income. All right, so that leaves us with the money Greg is paying himself. Okay, so is it going to be something that decreases his taxable income or not? Well, that's going to depend on how his entity is set up. Okay, so if Greg is an S-Corp officer, okay, his business is set up as an S-Corp, and he is paying himself via W-2 wages, then that's deductible. He's an employee in his business. So the money he's paying himself, the money the business is paying himself via W-2s is a tax deduction to his business. All right, then of course, the W-2 income is then income to him on his personal return because it's a W-2. But to the business itself, it is deductible. If Greg is a partner in a partnership, and he's being paid what's called guaranteed payments, then these are also deductible. Okay, guaranteed payments to a partnership are deductible to the business, and then again will be income to Greg on a personal level on his individual income tax return. But if Greg is paying himself via draws or distributions through any entity means, all right, that includes draws from your S-Corp, draws or distributions from your partnership, and if you're a sole prop or a single member LLC, then anything you pay yourself is considered a draw or a distribution. Okay, that's not going to reduce your taxable income. Okay, so if you report your income, your business, on a Schedule C of your individual tax return, okay, because you're a sole proprietor or you're a single member LLC, okay, then the money that you take out of your business for personal use, essentially the way you pay yourself, not a business deduction. Okay, and why is that? Because in order to be deductible, you guys, from your business income, think of it, if it's deductible to you, it has to be considered income somewhere else, okay, to someone else. So think about those payments to your contractors, okay? Deduction to you, but going to be income to your contractors. Payments to your software company, deductible to you, income to the software company. Give me plenty, if you're in the chat and you guys want to give me examples of other things you're not, you want to ask about or things that you think about. But if it's deductible to you, it has to be income somewhere, typically, okay? And so when you're a single member LLC or a sole prop and you are paying yourself, that money to you personally is, when you take those draws or distributions, isn't taxable. Therefore, it's not deductible to your business. Okay, it's a non-taxable event. Okay, so I hope that makes sense. So going back to Greg's original question is, how do you calculate your taxable income? So it's revenue, all the money you bring in, less your expenses, all the business related activity going out. All right, so it's really important that you understand when that money goes out, whether it's a tax deductible expense or something not. And that's where, even if it's a tax advisor or even your bookkeepers, might be able to help you with this if you have a bookkeeper but not an advisor, or any sort of accountant might be able to guide you on this. And if they can't, then that's when it's time to get a tax advisor on your side.